Happy Thursday out there, Team 42. It's your skipper here at Darius Dell to present our macro minute for Thursday, April 10th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, did the bond market break President Trump? Our answers are, yesterday, the S&P 500 and NASDAQ 100 melted up 9.5 and 12% respectively, their best day since October 2008, after President Trump postponed the greater than 10% portion of reciprocal tariffs by 90 days. This comes amid a further hike in the aggregate China tariff rate to 125%. Part of the reason markets rallied so hard yesterday was that this was the first time anyone thought the art of the deal could actually work to realign global trade with relatively minimal disruption, ourselves included. All told, the fact that the Trump put was exercised or at a minimum rolled to July 9th due to stress in the Treasury bond market has both positive and negative implications. On the positive side, it clears the way for, at most, a retest of the lows in the interim, and at best, a sustained uptrend from here. On the negative side, it is confirmation of the growing geopolitically driven supply-demand imbalance we have been warning about in the Treasury bond market. 42 Macro clients refer to slides 56 through 84 of our April 2025 Macro Scouting Report presentation from last Friday for more details. Refer to our note yesterday for why we believe the best method for investors to safely navigate these fork-turning polycrisis dynamics is via the use of proven risk management overlays like KISS and Dr. Mo. Trust me, as a renowned global macro expert, there are far too dimensions of scenario analysis to handicap to properly precision portfolios for these interconnected risks using fundamental research alone. 42 Macro clients, remember what we have consistently coached you on all year. Number one, bear markets are at least twice as hard to risk manage as bull markets are easy. Number two, leave the shorting of assets to the highly paid professionals that are being compensated for taking on four-sided portfolio construction risk and the added stress that entails. And number three, the distribution of probable economic outcomes is as far and wide as most investors have ever seen, so remain dispassionate and ready to pivot if and when KISS and Dr. Mo pivot. Odds are you'll thank them later, even if you or we do not trust or fully understand why from a fundamental standpoint in the moment. The market is smarter than we are, and there's someone always knows something, as evidenced by Donald Trump's all caps, "This is a great time to buy" tweet at yesterday at 9:37 a.m. Eastern. Transitioning to our 42 Macro dashboard, as always, we'll wrap up with the question from our community. This one's regarding the Trump put. It says, "Hi, DD, given that the bond market now knows the Trump guardrail and level of and pace of higher yields, do you think bond vigilantes exploit that knowledge to force a more restrictive tax and spending package, aka the House version versus the Senate version?" This is 5D chess right here. Fantastic question from one of our thousands of clients. We appreciate each and every one of them. They make me smarter. We make each other smarter here in our community dashboard. So let me take a stab at trying to answer these questions, understanding full well that I don't have all the answers. I don't think anybody does, not even Donald Trump himself. So the answer is yes, that very well could be the case. One of the core elements of our triple S's theme is the fact that we could potentially see House deficit hawks in the House essentially force a tighter, a smaller, more restrictive, less stimulative tax and spending package. And so very clearly we saw what the impact that the bond market had on President Trump's willingness to play hardball. Obviously, it forced them to exercise the Trump put, at least temporarily. And so ultimately what that may mean is that when we're getting further into this sort of reconciliation process, if it seems that if the bond market sniffs out at the Senate, which is calling for about $7 trillion of debt finance tax cuts versus the House's kind of $4 trillion, if the bond market starts to get really concerned about the Senate current policy route, then we could easily see yields spike again. We could see foreign creditors, of which they own 8.5% of marketable treasury securities, roughly 30% of that market, continue to dump bonds as they become increasingly concerned about the U.S.'s fiscal sustainability dynamics. This is stuff that we've been coaching our clients on for years in the context of our investing in forward-turning regime analysis, and most recently in the left tail section of our macro scouting report, which obviously had some market impact this week. So that's very much an issue. And going back to the key takeaway from today's lead-off morning note, between now and July 9th, it's very unlikely that we break to new lows in asset markets, right? Unless, of course, Trump changes his mind and there's no more negotiations or something like that. Obviously, we don't have a view on that. But if between now and July 9th, what you're probably going to see is a bunch of negotiations. Everything's going to be going great for the most part. They might have to punt it again to give them more time to negotiate. And so that's all bullish from that perspective, because that creates right tail risk, but it also removes left tail risk. So you're just shifting the entire distribution to the right from the perspective of a financial market. So it'd be hard to see markets break down below that between now and July 9th. But where you could see markets break down below that after July 9th, or whatever extension that we may see in the future, is when markets get concerned that tax cuts and deregulation aren't enough to offset what are already mounting headwinds to the economic outlook. Obviously, we still have the tariff hikes, right? I think the effective tariff rate has gone up like 15 percentage points, or sorry, to around 15% rather, from about 2.5% prior to Trump taking office back in January. So that is a negative supply shock to the economy. It's just not as big as what we thought it was going to be prior to yesterday afternoon. Two, we also have Doge. If Elon is not lying to us, because he's certainly said this multiple times over the last 3 weeks, which is they're aiming to take about 15% out of annual federal expenditures, which are currently annualizing at about $7.5 trillion. Elon thinks it's about 7, but I'm not sure if he's seen the most recent Treasury budget statement. But that's about $1 trillion. They're aiming for $1 trillion of just a deficit, or not deficit reduction, $1 trillion of expenditure reduction out of annual federal expenditures. And that's obviously a headwind to growth. That's a negative demand shock to the economy. And then lastly, you have just a general level of uncertainty. Even though negotiations are happening, we still don't know where the ultimate destination is. So if you're a business, especially if you're a business in the manufacturing sector, you're going to be sitting on your hands to figure out, okay, where are the tariff rates going to settle out? What are the new rules of the road, or what's the new rules of the game as it relates to globalization and arbitraging, the cost of production across borders. To me, I don't know that you can proceed full speed ahead like you would in a normal economy, with this level of uncertainty on the policy front, even just as a manufacturer. But if you're a broader business, how do you know? They keep saying tax cuts and deregulation, but you have no idea what that's going to look like. All you know is that they're going to extend what their current tax rates are, which is not stimulative to the economy. You need additional tax relief to create a positive fiscal impulse, or maybe it won't be net positive, but it'll be at least a positive in that, grossly positive in that specific category. And so, this could get potentially hairy beyond July 9th if the markets see Doge, the tariffs that have already been implemented, plus elevated policy uncertainty contributing to a MBR style actual recession, and the bond vigilantes, just much like what we just saw, eventually force the House or force the Congress to adopt a much more restrictive tax package. And ultimately, if you're heading into recession, tax cuts aren't that stimulative anyway, because again, the tax base is going to be cyclically declining in a recession. So cutting taxes in a recession is great, but it's certainly not as great as actually the government printing money to spend. And so just be aware of that. And same thing with deregulation. These are supply side, benefits to the economy. But again, you go back to 1980, 1981, when Ronald Reagan kitchen sinked the economy to usher in supply side reforms. They still wound up in a recession because, again, deregulation is great, but it's not going to cause a company to, stop what they're doing in terms of, taking a defensive posture from an investment and hiring standpoint and rotate to taking an offensive posture because, you deregulated, right? You need a catalyst for them to say, I want to expand my business. I want to start a new business and create more supply and more production in the economy. And I don't think deregulation is a big enough catalyst in isolation. It's obviously bullish and supportive at the margins, and certainly will be very bullish as our incremental tax cuts if we don't go into an NBR style recession. But I think the jury's still very much out on that. We have to give it some time in terms of analyzing the data over the next few months. So hopefully that, by the way, that's only like a narrow subset of what we're talking about here, is growth and fiscal policy and how that's impacting growth. There's liquidity. There's the global debt refinancing air pocket that we're currently in. There's monetary policy response to that. Is inflation going up or down? There's all these other fundamental factors that we don't even have time to unpack right now. This is why we do so much research here, just to help our clients understand that full distribution of probable outcomes, not so that we can take this fundamental knowledge and tell them to go, buy this or sell that. No, that's what Kiss and Dr. Mo do down here in the bottom left on our dashboard. That's what Kiss and Dr. Mo do. What I do as the fundamental sort of, kind of macro strategist, economist, fiscal policy analyst, whatever you want to call me, what I do on top of Kiss and Dr. Mo is help our clients understand that full distribution of probable outcomes, so that when Kiss and Dr. Mo start to signal something different and tell them to make significant changes in their portfolio, they feel confident enough to dispassionately execute those changes because they understand that, hey, the market is going from pricing in these things Darius has been talking about for months and helping us prepare for, to now the market wants to start pricing in this side of the distribution that the market that Darius has been preparing us for. That's it. And this is how the best investors in the world invest. I've been flying around the world, meeting with all of them, or not all of them, but many of them for the past 16, 17 years. And I've taken a lot of, institutional knowledge from our interactions, just as they have taken a lot of institutional knowledge from me. We all make each other smarter, when we're in these institutional client meetings around Global Wall Street, in the same way that our investors and our members make each other smarter here in our community chats. So this is a fantastic experience. I'm really blessed to be kind of at the epicenter of a lot of, incredible learning and incredible risk management during the middle of what could potentially be a global financial crisis. And so I just want to say thanks everyone for tuning into these. We'll catch you back here tomorrow rather. So everyone have a great day. Darius Dell here presenting our macro minute for Thursday. Is it Thursday? Yeah. This is how much work I've been doing this week. I don't know if it's Wednesday or Thursday, but it's Thursday. I know it's Thursday. Thursday, April 10th, 2025. Everyone have a wonderful day. Best of luck out there, and we'll catch you back here tomorrow. Cheers.